There's a saying in trading that's been passed down through generations of market veterans, a phrase that captures the essence of what it truly means to survive in the world of finance. There are old traders, and there are bold traders, but there are very few old, bold traders. This saying isn't just a clever turn of phrase, it's a hard-earned truth, forged in the fires of market booms and busts, and echoed in the stories of those who've lasted decades in the game. The phrase is a warning, a gentle nudge to every ambitious newcomer. Boldness can bring you thrilling victories, moments of adrenaline, and even the occasional windfall. But more often than not, it's a path that leads to heartbreak and empty accounts. The market is a relentless teacher, and it punishes overconfidence without mercy. In the long run, the market rewards those who approach it with discipline, patience, and humility, not those who rely on bravado or luck. The traders who last are the ones who treat risk with respect, who know that every trade is a potential lesson, and who never let a single win or loss define their journey. Old traders endure because they've learned to focus on survival above all else. They understand that the real secret to building wealth isn't in chasing every hot tip or swinging for the fences, but in letting their capital grow steadily, year after year. They keep meticulous records, review their mistakes, and adapt their strategies as the market evolves. Bold traders, on the other hand, are often drawn to the excitement, the rush of a big win, the thrill of taking risks. But this excitement comes at a cost. All it takes is one misstep, one moment of overconfidence, and years of gains can vanish in an instant. The market is littered with the stories of those who flew too close to the sun. In trading, survival is the ultimate skill. It's more important than any hot tip, any moment of courage, or any single trade. The traders who make it through the storms are the ones who know when to step back, when to cut their losses, and when to simply wait for a better opportunity. The market always finds a way to humble the reckless. It's a place where egos are tested and only the disciplined endure. In the end, it's not about being the boldest or the oldest, it's about being wise enough to last. High-risk trading is seductive, drawing people in with the promise of fast money and the thrill of the unknown. The flashing lights, the ever-changing numbers, and the stories of instant millionaires create an atmosphere that feels almost electric. For many, the idea of turning a small sum into a fortune overnight is irresistible, and the excitement of taking big risks can be intoxicating. We crave quick riches and dramatic success stories because they tap into our deepest desires for achievement and recognition. The allure of being the next big winner, the one who outsmarts the market, is a powerful motivator. Social media and news headlines amplify these stories, making it seem like everyone is striking gold, except us. New traders, lured by tales of overnight fortunes, often ignore the reality. The market is a game of probabilities, not guarantees. The truth is, for every story of a massive win, there are countless untold stories of losses and heartbreak. The market rewards discipline and patience, not reckless bets. Leverage amplifies both gains and losses, turning small moves into massive swings. It's like playing with fire. When it works, the rewards are huge. But when it doesn't, the consequences can be devastating. Many traders are drawn to leverage for the chance to multiply their profits, but few fully understand the risks involved. Most focus only on the upside, blinded by optimism and the hope of hitting it big. They ignore the very real possibility of losing everything in a single bad trade. This selective attention is fueled by our natural tendency to remember wins and forget losses. The tools, meant for professionals, complex trading platforms, advanced order types, and high leverage, are often misused by novices. Without proper knowledge and experience, these tools become dangerous, creating a recipe for disaster. Many new traders jump in without understanding the risks, believing that more tools mean more success. Ego and the need to be right drive many to take outsized risks, pushing them to double down on losing trades or chase after the next big win. The desire to prove oneself, to be seen as a genius or a maverick, can cloud judgment and lead to reckless decisions. Seeking validation from big wins becomes a cycle. Each success brings a rush of dopamine, reinforcing the behavior and making it harder to walk away. The praise from friends, the likes on social media, and the feeling of being on top of the world all feed into this addiction. This emotional high is addictive. creating a powerful feedback loop that keeps traders coming back for more. The anticipation, the risk, and the occasional big win combine to create a rush that's hard to match in any other activity. But the market's unpredictability makes it a dangerous pursuit. What goes up can come crashing down in an instant, and the same volatility that creates opportunity can also wipe out months or years of gains in a single moment. True trading success comes from patience, discipline, and a willingness to learn from mistakes. The best traders know that it's not about one big win, but about making smart decisions over and over again. Wealth is built over hundreds of trades, not one lucky bet. Keeping detailed records, reviewing past trades, and constantly improving your strategy are the real keys to long-term success. Those who sprint for quick gains burn out fast, overwhelmed by stress and the emotional roller coaster of high-risk trading. The constant ups and downs take a toll, leading many to quit before they ever see real results. The marathoners, those who manage risk, stay disciplined, and focus on the long game, are the ones who last. In the end, trading is not about chasing thrills, but about building lasting wealth through patience, strategy, and self-control. Many traders underestimate how hard it is to recover from big losses. Lose 50% of your account, and you need a 100% gain just to break even. The deeper the loss, the steeper the climb back. This is why capital preservation is the top rule for professionals. Small, manageable losses are part of the game. Catastrophic ones end your career. Risking large chunks of your account may seem tempting, but the math is merciless. Old traders keep losses small, so recovery is always within reach. The market's math punishes the bold, but rewards the disciplined. Jesse Livermore, the great bear of Wall Street, was a legendary bold trader. He made and lost fortunes by taking massive, high-conviction bets. His wins were spectacular, but his lack of risk control led to repeated ruin. Livermore's story is a cycle of boom and bust. Brilliance undone by undisciplined risk. Despite his genius, he never learned to protect his capital after big wins or losses. In the end, the market's volatility broke him, both financially and emotionally. Livermore's life is a cautionary tale. Skill means nothing without risk management. Even the boldest can't outlast the market without discipline. Trading success is determined by your mind, not your strategy. Dopamine, the brain's reward chemical, makes risky wins feel euphoric and addictive. This leads to euphoria trading, chasing the next high with bigger, riskier bets. After losses, the urge for revenge trading kicks in, clouding judgment and compounding mistakes. The market punishes emotional, impulsive decisions. Old traders recognize these traps and have routines to reset after wins or losses. They separate emotion from action, sticking to their plan regardless of recent outcomes. Mastering your psychology is as important as mastering the market. Discipline breaks the cycle of boom and bust. Consider Anna and Ben, two traders who both possess a sharp eye for the markets and use the same winning strategy. On paper, they seem equally matched, but their approach to risk couldn't be more different. This difference, though subtle at first, will ultimately determine their fate as traders. Ben is drawn to the thrill of fast profits. He risks 25% of his account on every trade, convinced that big bets will lead to big rewards. The adrenaline rush of seeing his account balance spike after a win is addictive, and he quickly becomes overconfident. After a couple of successful trades, Ben feels unstoppable, like he's cracked the code to easy money. But the market is unpredictable. Just 2 losing trades in a row don't just erase his gains. They leave his account in the red, and his confidence shattered. The emotional roller coaster of big wins and bigger losses takes its toll. Anna, on the other hand, takes a measured approach. She risks just 2% of her account per trade, no matter how confident she feels. She keeps a detailed journal, reviews her trades, and focuses on consistency over excitement. When Anna experiences the same sequence of wins and losses as Ben, her account barely flinches. A small dip here and there, but nothing catastrophic. She doesn't panic, because she knows her risk is always under control. Ben's aggressive style leads to wild swings in his account balance. The equity curve looks like a roller coaster, sharp climbs followed by steep drops. Eventually, a string of bad trades wipes him out completely, forcing him out of the game. Anna's discipline, however, keeps her in the game. Her account grows slowly but steadily, and she's able to weather the inevitable losing streaks. Over time, her edge as a trader is allowed to play out, compounding her gains. Even the most skilled trader can lose everything if they ignore risk. Reckless risk-taking destroys accounts, no matter how good your strategy is. It's not just about making money, it's about protecting what you have. By making small, consistent bets, you protect yourself from the inevitable losing streaks that every trader faces. This approach might seem slow, but it's the only way to ensure you survive long enough to see your strategy work. The real edge in trading isn't just about having a great strategy or being the smartest person in the room. It's about patience, discipline, and surviving the ups and downs. Only by managing risk can you give your skills the time they need to pay off. In the end, risk management isn't just a safety net. It's the foundation of long-term trading success. In trading, risk management beats raw talent every time. Market volatility is the ultimate test for traders. In calm times, reckless habits may go unpunished, giving bold traders false confidence. But when volatility spikes, aggressive risk and high leverage become lethal. The disciplined trader cuts position size, widens stops, and focuses on defense. The bold trader is wiped out by the storm. The old trader survives to trade another day. Volatility filters out the unprepared, leaving only the risk-aware standing. In chaos, survival is the only victory. Professional traders don't make huge all-in bets. They risk a tiny fraction, often 0.5% to 2% of their capital per trade. This keeps losses manageable even during losing streaks. Like a casino, they rely on a small edge playing out over thousands of trades. The bold trader gambles for a quick win. The professional plays the long game. Process and discipline, not excitement, are their focus. Small bets are the foundation of every lasting trading career. The real edge is boring, but it's what keeps professionals in business. The golden rule of trading is simple: survive first, then thrive. Profit is a byproduct of survival. If you blow up, you're out of the game. Old traders obsess over risk, not reward, ensuring every loss is small and manageable. Wealth in trading is built slowly, through compounding small gains and protecting capital. The thrill isn't in a single big win, but in the steady climb of your equity curve. If you want to last, abandon the dream of being bold. Embrace discipline and risk management. Define your risk pod. Keep it small and never risk what you can't afford to lose. Survive, and the profits will follow.